Every day, the world gives us headlines. But headlines are not history. They are fragments, brief flashes of movement that tell us what rose, what fell, and what frightened the market before breakfast. They rarely tell us what the movement means. Today's subject is real. The investment is real. The data centers are real. The chips, the profits, the electricity demand, the corporate spending, and the extraordinary expectations surrounding artificial intelligence are real. So are the warning signs. This video is not fiction. It is not financial advice. It is not an invented speech from Winston Churchill. It is a modern financial and geopolitical essay written through a Churchillian lens, a lens of discipline, technology, ambition, power, fear, and the dangerous human habit of believing that a new age has abolished the lessons of every age before it. Artificial intelligence may transform the world, but history asks a colder question. How much should the world pay today for profits that may arrive tomorrow? That question has become more urgent because of a strange contradiction now visible inside the American stock market. From a distance, the market can appear powerful. Major indices can approach record territory. Corporate earnings can expand. The largest technology companies can report revenues and profits that would have been almost unimaginable a generation ago. Yet beneath that apparent strength, the foundations of the advance can become narrower. An index can rise while fewer companies participate. It can create the impression of broad prosperity even when much of its performance depends on a limited number of enormous businesses. The headline remains impressive, but the machinery producing it becomes increasingly concentrated. This was the concern behind a warning that emerged from Bank of America in early June 2026. According to media coverage of a Bank of America client note dated June 5th, strategists led by the bank's head of U.S. equity and quantitative strategy, Savita Subramanian, concluded that there were too many red flags in the American stock market. The reported title of the note was unusually direct. It advised investors to consider taking profits after a powerful rally. That language attracted attention because large financial institutions are normally careful about issuing broad warnings. Their research is written for clients with different objectives, different time horizons, and different levels of risk. A recommendation to take some profits is not the same as declaring that every investor must sell everything. Nor is it a forecast that a collapse will begin on a particular morning. It is an assessment of vulnerability. According to coverage of the note, 7 of Bank of America's 10 bear market signposts had been triggered. 5 had reportedly appeared by April, with 2 more activated during May. The phrase sounds precise. It may even sound like a countdown. It is not. A bear market checklist is not a machine that predicts the exact day when prices will turn. It is an attempt to organize conditions that have often appeared near previous market peaks. Those conditions may include elevated valuations, excessive optimism, easy access to capital, aggressive merger activity, speculative trading, weak market breadth, optimistic economic assumptions and financial conditions that encourage investors to take greater risks. Each indicator asks a different question. How much are investors paying for each dollar of earnings? Are they expecting unusually strong growth to continue indefinitely? Is credit readily available to businesses with weak financial foundations? Are companies pursuing acquisitions because opportunities are genuinely attractive, or because expensive shares provide convenient currency? Are investors studying businesses, or simply chasing whatever has recently risen? Is the market advancing across many industries, or being carried by a small number of giants? And are interest rates, inflation and liquidity supporting high asset prices, or beginning to work against them? Taken together, these signs can describe the emotional and financial temperature of a market. They cannot tell us the precise moment when the temperature becomes unbearable. This distinction matters because warning indicators can remain elevated for a long time. Markets are not controlled by a single equation. They are influenced by earnings, interest rates, liquidity, policy, technology, psychology, and the decisions of millions of participants. An expensive market can become more expensive. A narrow rally can persist. Optimism can survive evidence that would have ended it under different conditions. History contains many examples of investors who correctly identified an imbalance but underestimated how long it could continue. Being early may eventually look wise in a history book. In a portfolio, being early can feel remarkably similar to being wrong. That does not make warning signals useless. It means they must be interpreted as instruments of examination rather than clocks of destiny. Bank of America's valuation analysis added another layer to the concern. According to media reports describing the client note, the bank judged the S&P 500 to be statistically expensive on 17 of the 20 valuation measures it monitored. On 8 of those measures, current valuations were reportedly higher than the levels observed during the dot-com era. This is a serious comparison. It is also one that must be handled carefully. There is no single official valuation of the stock market. Analysts can examine price relative to expected earnings, historical earnings, sales, cash flow, book value, economic output, or other financial measures. They can adjust those calculations for inflation, profit margins, sector, composition, and interest rates. Different methods can produce different conclusions because they are measuring different aspects of the same market. Bank of America's conclusion therefore represents the bank's analytical framework. It does not mean that every conventional valuation ratio has already surpassed the most extreme levels of 1999 or early 2000. FactSet's more familiar forward earnings measure provides an important counterweight. In its May 8th update, FactSet estimated that the S&P 500 was trading at roughly 21 times expected earnings over the following 12 months. That was above the average of the previous 5 years and above the average of the previous 10. The market was expensive relative to its recent history, but that reading alone did not establish that every part of the market had returned to the most extreme conditions of the dot-com peak. Nor did it prove that prices were about to collapse. This is where financial discussions often lose discipline. One side sees elevated valuations and declares that disaster is inevitable. The other sees strong earnings and concludes that valuation no longer matters. Both positions remove uncertainty by pretending to know more than the evidence allows. Valuation is neither irrelevant nor omnipotent. It is best understood as a measure of the margin for disappointment. When investors pay a modest price for a company, the business may survive slower growth without causing catastrophic losses for shareholders. But when investors pay an extraordinary price, the company must often deliver extraordinary results merely to justify the price already paid. The business does not have to fail. It may only need to perform slightly less brilliantly than expected. A missed revenue target, a weaker profit margin, a delay in new products, a rise in interest rates, or a cautious forecast from management can suddenly matter far more when expectations have been elevated to perfection. High valuation makes a market sensitive. It does not schedule the event that will test that sensitivity. For a major correction to occur, investors usually require some form of catalyst. The catalyst might be declining earnings expectations, tighter monetary policy, credit stress, geopolitical conflict, weaker consumer demand, or the realization that a celebrated investment cycle will take longer to produce returns than previously believed. Without such a catalyst, enthusiasm may continue, and strong earnings can genuinely justify part of the optimism. FactSet's data in the spring of 2026 showed substantial profit growth and historically strong aggregate margins among S&P 500 companies. Those are not imaginary foundations. They distinguish the present environment from a market supported only by slogans and business plans. But real earnings do not make price irrelevant. They merely make the argument more difficult. Another warning identified by Bank of America involved the extraordinary gap between winners and losers inside the technology sector. According to reporting on the bank's analysis, the performance difference between the strongest and weakest technology shares had widened to approximately 120 percentage points, a level not seen since February 2000. The importance of that finding is not that history must repeat itself, because a number resembles one recorded 26 years earlier. The importance lies in what such dispersion may reveal. Technology is often discussed as though it were a single industry moving in one direction. In reality, it contains semiconductor designers, chip manufacturers, networking suppliers, cloud platforms, cybersecurity firms, enterprise software companies, consumer internet businesses, data center operators, and speculative ventures, whose connection to artificial intelligence may be stronger in promotional language than in demonstrated revenue. A wide performance gap tells us that investors are making increasingly severe distinctions among those businesses. Some companies are being rewarded as essential owners of infrastructure, computing power, distribution, or intellectual property. Others are being treated as vulnerable, replaceable, or unable to convert technological enthusiasm into durable profits. That separation can be healthy. Markets are supposed to distinguish strong companies from weak ones, but extreme separation can also indicate uncertainty beneath the surface. Capital crowds into a small group of perceived survivors while confidence disappears elsewhere. The index may remain strong because the winners are enormous, even as a growing number of companies lose momentum. This is one of the peculiar features of a market capitalization-weighted index. The largest companies have the greatest influence. A 1% increase in a company worth several $1 trillion can outweigh substantial declines across dozens of smaller businesses. The index rises, the television graphic turns green, and the public receives the message that the market had a good day. But the experience of the average stock may be far less impressive. This is why market breadth matters. Breadth asks how many companies are actually participating in an advance. It can be measured in several ways: the number of shares reaching new highs, the proportion trading above long-term moving averages, the balance between advancing and declining stocks, or the performance of an equal-weighted index compared with its market cap-weighted counterpart. No single measure is perfect. Yet when an index approaches records while relatively few members reach their own highs, the market is communicating something important. The advance is becoming dependent on a smaller group of leaders. Dependency is not the same as imminent failure, but dependency creates fragility. An army advancing across a broad front can endure the loss of one position. An army moving through a narrow passage may be powerful at its head and vulnerable throughout its entire formation. A Churchillian strategic mind would understand that distinction immediately. It would not condemn confidence. Confidence is necessary for investment, invention, and national development. No society builds new industries by assuming that every effort will fail. But confidence has a disciplined form and a dangerous form. The disciplined form recognizes uncertainty, prepares for setbacks, and preserves the resources required to continue. The dangerous form treats recent success as proof of permanent safety. That is the difference between courage and recklessness. Courage sees the danger clearly and advances because the objective justifies the risk. Recklessness denies that danger exists because acknowledging it would disturb the excitement of the advance. The modern market does not possess a mind or a moral character. It is a system of prices produced by human judgment. But precisely because it is human, it absorbs human weaknesses. Imitation, vanity, fear, impatience, and the desire to believe that prosperity has become effortless. A society can begin to treat rising prices as evidence of intelligence. Investors become convinced that wealth created by valuation is identical to wealth created by production. Companies learn that attaching themselves to a popular narrative can reduce scrutiny. Analysts become reluctant to challenge a trend that has repeatedly punished those who questioned it. Ordinary savers, seeing others grow richer, enter not because they understand the asset, but because exclusion feels more dangerous than participation. Momentum gradually replaces judgment. The warning from Bank of America should not be treated as a command to panic. Another institution may examine the same earnings, interest rates, and technology spending and reach a more constructive conclusion. Bank of America itself did not declare that a crash was guaranteed. Its warning is more useful when understood as a challenge. What assumptions are now embedded in prices? How much future growth has already been purchased? How dependent has the index become on a few enormous companies? How much disappointment can the market absorb before confidence changes character? These are not questions for pessimists alone. They are questions that become most important when optimism appears strongest. Markets rarely punish hope merely because it is hope. They punish the moment when hope is allowed to replace judgment, when price loses contact with the range of plausible outcomes, and when investors confuse a powerful idea with an investment that cannot fail. The current American market may continue rising. Earnings may keep expanding. The largest companies may prove that their extraordinary valuations reflected extraordinary economic power. But the higher expectations climb, the more evidence they must eventually produce. The greatest question is not whether the market is expensive. It is why investors have become willing to pay so much. And the answer begins with two letters: AI. Artificial intelligence did not create the present market enthusiasm by appearing suddenly out of nowhere. For decades, researchers had been developing machine learning, neural networks, speech recognition, computer vision, and increasingly powerful methods of processing information. Businesses had already been using algorithms to recommend products, detect fraud, target advertisements, translate languages, and organize vast quantities of data. But the public experience changed dramatically when generative AI became widely accessible. A technology that had previously seemed distant and technical could suddenly answer questions, produce images, summarize documents, write software, analyze information, and imitate forms of human communication within seconds. The transformation was psychological as much as technological. Millions of people did not merely hear that artificial intelligence was advancing, they interacted with it directly. Executives began asking whether every company would need an AI strategy. Governments considered its military, economic, and political implications. Universities debated its effect on education. Workers wondered whether it would improve their productivity, replace parts of their jobs, or eventually make some occupations unnecessary. Investors saw something even larger. They saw the possibility of a general-purpose technology. A general-purpose technology is not simply a better product within one industry. It is a capability that can spread across much of the economy, changing how other goods and services are produced. Electricity did this. The internal combustion engine did it. Computing and the internet did it. Artificial intelligence may do it as well. In healthcare, it may help researchers identify promising drug candidates, interpret medical images, and manage clinical information. In finance, it may accelerate analysis, detect fraud, and automate routine operations. In logistics, it may improve routes, inventories, and supply chains. In defense, it may influence intelligence, surveillance, autonomous systems, communications, and strategic planning. In advertising, it can generate and test material at enormous speed. In education, it may provide personalized assistance while creating difficult questions about accuracy, assessment, and intellectual dependence. In scientific research, it may help discover patterns that would otherwise take human teams years to examine. And across ordinary offices, it may reduce the time required to draft reports, search documents, analyze data, write code, and complete repetitive administrative work. This is the economic promise behind the enthusiasm. If AI can raise productivity across many sectors, its value will not be limited to the companies that build the models. It may influence wages, corporate margins, national output, and the balance of power between countries. That possibility explains why the market began assigning extraordinary strategic importance to the companies controlling the essential layers of the system. The first layer is computing. Advanced AI requires enormous quantities of specialized processing power. This placed semiconductor designers, manufacturers, memory suppliers, and networking companies at the center of the investment cycle. Nvidia became the most visible symbol of this transformation, not because every AI application belongs to Nvidia, but because its processors, networking systems, and software ecosystem became critical components in training and operating many advanced models. And unlike many celebrated companies during the dot-com period, Nvidia's success has already appeared in reported revenue and profit. For its 2026 financial year, the company reported revenue above $200 billion, with data center demand accounting for most of the expansion. Its results demonstrated that the demand for AI infrastructure was not imaginary. Companies were paying extraordinary sums for real equipment delivered into real facilities. But semiconductors are only one part of the system. The second layer is cloud computing. Amazon, Microsoft, and Alphabet operate enormous cloud platforms that allow businesses to rent computing capacity rather than build every system themselves. AI increases the strategic value of those platforms because most organizations cannot independently purchase, install, and manage the infrastructure required to train and deploy advanced models. The third layer consists of the hyperscalers themselves, companies with enough capital, engineering talent, data, customers, and global reach to build infrastructure at a scale available to very few competitors. Microsoft, Amazon, Alphabet, and Meta are often discussed together because each is investing heavily in computing capacity. Yet they should not be treated as identical businesses. Microsoft combines enterprise software, cloud services, and partnerships with model developers. Alphabet possesses search, advertising, cloud computing, consumer platforms, and its own AI research and model ecosystem. Amazon operates the world's largest cloud platform while also managing retail, logistics, advertising, and other businesses. Meta applies AI to advertising, recommendations, and consumer platforms while investing in models and the infrastructure needed to support them. Oracle has a different position, with database technology, enterprise customers, and a rapidly expanding cloud infrastructure business. Each company faces different revenue opportunities, cost structures, competitive pressures, and valuation risks. To call all of them AI stocks may be convenient. It is not sufficient analysis. Beyond these giants lies an even wider industrial system. Semiconductor manufacturing equipment, memory, networking, data center construction, cooling technology, power generation, transformers, transmission lines, land, fiber connections, and specialized engineering. AI may appear on a screen as a weightless digital service. Its physical foundation is anything but weightless. It requires factories capable of producing advanced chips. It requires data centers large enough to contain immense clusters of machines. Those machines generate heat and require cooling. They consume electricity continuously. They depend on grids that were not designed for such concentrated new demand. They require construction workers, engineers, permits, water in some, cooling systems, and access to reliable power. The financial commitment has therefore expanded far beyond software development. Goldman Sachs estimated in May 2026 that annual global capital expenditure connected to the AI build-out could reach approximately $765 billion during the year. Its longer-term model suggested that annual spending might rise substantially further by the beginning of the next decade. Other estimates use different definitions and produce different totals. Some include only the largest cloud companies. Others include semiconductor manufacturing, power systems, data centers, and broader infrastructure. The precise number is less important than the scale. Hundreds of billions of dollars are being committed in a single year to create the industrial foundation for a technology whose ultimate revenue structure has not yet been fully established. This is where the argument becomes more complicated. The investment can be real, the demand can be real, the technology can be important, and the eventual return on all that capital can still be uncertain. A data center is not profitable merely because it contains advanced processors. It becomes economically valuable when customers pay enough to use its computing capacity over a sufficient period of time to cover construction, equipment, electricity, maintenance, financing, and replacement costs. Advanced chips also become obsolete quickly. The competitive race encourages companies to purchase new generations of hardware before the full economic life of earlier equipment has necessarily been exhausted. A facility built for today's systems may require expensive modification for tomorrow's. Power contracts, cooling designs, and networking architecture may all need to evolve. The great financial question is therefore not whether companies will continue using artificial intelligence. They almost certainly will. The question is whether future AI revenue will justify the scale and speed of the present investment. At first sight, the comparison with the dot-com era seems obvious. Then, under closer examination, it becomes both persuasive and incomplete. The similarities are real. The internet was recognized as a transformative technology. Investors understood correctly that it would alter communication, commerce, media, and daily life. But the truth of that technological insight encouraged a much more dangerous conclusion: that almost any company associated with the internet deserved an extraordinary valuation. Capital became abundant. The fear of missing the future became more powerful than the obligation to examine a business. Distant possibilities were converted into present prices. Weak companies discovered that fashionable language could attract investors before durable profits existed. The phrase, "this time is different," did not always need to be spoken. It was embedded in the behavior of the market. Artificial intelligence has created similar pressure. Corporate leaders fear that cautious spending may leave them permanently behind. Portfolio managers fear that failing to own the leading companies will damage their performance relative to the index. Smaller companies understand that describing themselves as AI businesses can attract attention unavailable to ordinary software or consulting firms. Investors begin paying not only for current earnings, but for dominance expected many years into the future. And once prices rise, the rise itself appears to validate the story. This is how technological conviction can become financial momentum. Yet important differences separate the present AI cycle from the most speculative years of the dot-com boom. Many of today's leading companies are not fragile startups dependent on continuous external financing. They are among the most profitable corporations in history. They possess established customers, global distribution, large existing businesses, and the ability to finance much of their investment through operating cash flow. Their data centers provide services that customers already purchase. Their advertising platforms, cloud businesses, software subscriptions, and consumer networks generate substantial revenue independent of the most ambitious promises about future AI. The present build-out also answers measurable demand. Cloud providers have continued reporting strong growth and large contractual backlogs. Nvidia's results show that companies are buying computing equipment on a vast scale. Businesses are deploying AI tools in coding, customer support, search, advertising, and document analysis. This is not a market in which every leading company has revenue only in a presentation. But strong companies can participate in an investment cycle that becomes excessive. Profitability reduces one kind of risk. It does not eliminate the possibility of overbuilding, poor capital allocation or excessive valuation. History provides a useful distinction. Railways transformed civilization. They connected cities, reduced transport costs, expanded trade, and changed military logistics. Yet railway investment also produced repeated financial bubbles. Too many lines were built in some regions. Capital was committed at unrealistic prices. Competition reduced returns. Shareholders lost money even while society benefited from the infrastructure they financed. The internet produced the same paradox. It changed the world more profoundly than even its most enthusiastic early supporters could fully describe. But many investors who believed correctly in the internet still lost heavily because they paid too much for the wrong companies at the wrong time. Technology can succeed while an investment fails. That sentence is central to understanding the AI debate. The market is not deciding whether artificial intelligence will exist. It is trying to determine who will capture the economic value. Will most of the profit remain with the semiconductor suppliers that provide scarce computing power? Will it move to cloud platforms that operate the infrastructure? Will model developers create durable advantages? Or will models become increasingly interchangeable? Will enterprise software companies charge more because AI makes their products valuable? Or will AI reduce the cost of developing competing software? Will ordinary companies capture the greatest gains by using AI to reduce costs? Or will customers benefit most as competition makes intelligence cheaper? These questions have not been settled. During the early stages of a technological revolution, the suppliers of scarce equipment often earn exceptional returns. But scarcity can attract competition and new capacity. Prices may fall. Customers may gain negotiating power. Technology may improve so rapidly that the same task requires less computing capacity in the future. An enormous infrastructure build-out may therefore produce two very different results. It may create the foundation for decades of profitable growth, or it may create excess capacity that lowers prices and transfers much of the economic benefit from the builders of the infrastructure to its users. Both outcomes would represent technological progress. Only one would justify every investment currently being made. There is also a danger that the companies spending most aggressively begin competing against one another in ways that reduce returns for all of them. Each hyperscaler may fear that spending less will surrender strategic territory. The rational decision for one company can therefore contribute to an irrational outcome for the group. No single company wishes to be the power that failed to build. So all of them build. Capacity expands. Models improve. Prices decline. Customers benefit. But the return on each additional dollar of investment may weaken. This is not proof that such weakening has already occurred. Strong cloud growth and persistent capacity constraints suggest that demand remains substantial. Goldman Sachs has argued that the physical build-out may be larger and last longer than many investors expect. JP Morgan has emphasized the earnings growth, cash generation, and profitability supporting the current AI leaders. The bullish case deserves to be taken seriously. AI adoption may still be in its early stages. The cost of computing may decline enough to unlock uses that are currently uneconomic. Businesses may move from experimental projects to widespread deployment. AI agents may perform increasingly complex tasks across corporate systems. New applications may emerge that cannot yet be predicted. Infrastructure built today may become as foundational as electricity networks, mobile communications, or the commercial internet. If productivity improves across the economy, current investment may ultimately appear not reckless, but inadequate. This is why a Churchillian strategic mind would not reject the build-out merely because it was expensive. Had such a technology appeared during Churchill's era, its military and industrial significance would have been impossible to ignore. A system capable of processing intelligence, improving logistics, accelerating scientific research, assisting production, and strengthening communications would have been treated as an instrument of national power. Access to it would matter. control of its infrastructure would matter. The countries able to produce its essential components would possess strategic advantages over those dependent on foreign systems. But strategic importance would not excuse the absence of discipline. Resources committed to a new technology would still need to produce results. Capacity would need to serve a purpose. Industrial ambition would need to be matched by organisation, evidence, and accountability. A Churchillian mind would understand that refusing to invest in an essential technology can be a historic failure. It would also understand that urgency is not permission to waste. The importance of a weapon does not make every factory efficient. The importance of aviation does not make every aircraft design successful. The importance of artificial intelligence does not make every company invoking it valuable, every data center profitable, or every share price reasonable. The argument is no longer between people who believe in AI and people who do not. The serious argument is between those who believe the profits will justify the price and those who fear the market has already spent tomorrow's victory today. If the market has already spent tomorrow's victory today, what happens when tomorrow finally arrives? There is no single answer. The future of the AI market does not divide neatly into triumph or collapse. Between those extremes lies a range of outcomes shaped by earnings, interest rates, technological progress, competition, government policy, and the willingness of corporations to continue committing capital at the present scale. The first possibility is that earnings catch up. AI tools move beyond experimentation and become embedded in ordinary business operations. Companies use them not merely to generate demonstrations, but to reduce costs, accelerate research, improve customer service, automate administrative work, and create products that customers are willing to pay for. Revenue from AI services grows. Cloud demand remains strong. The infrastructure being built today produces acceptable returns over many years. In this outcome, the market does not need to fall dramatically for valuations to become more reasonable. Earnings rise beneath prices. The ratio between what investors pay and what companies produce gradually declines, not because the numerator collapses, but because the denominator expands. The market also broadens. Productivity benefits begin appearing outside the small group of companies selling chips and computing capacity. Healthcare businesses, financial institutions, manufacturers, logistics companies, and smaller software providers demonstrate measurable gains. Investors discover that the economic value of AI is distributed across a much wider group of businesses than the initial market leaders. The result would not be a repeat of the dot-com collapse. It might resemble a prolonged industrial expansion in which occasional corrections occur, but the underlying investment cycle remains intact. This is the strongest version of the bullish case. It should not be dismissed simply because the market is expensive. Many technological advances initially appear overestimated because their most important applications have not yet become visible. The commercial internet, smartphones, and cloud computing all developed through stages that were difficult to forecast from their earliest products. Artificial intelligence may be following the same path. What currently looks like excessive infrastructure could eventually appear necessary. What looks like premature spending could become the foundation of new industries. Today's leading companies may continue growing into valuations that now seem demanding. That possibility is real, but it is not guaranteed. The second outcome is a healthy correction. In this scenario, expectations cool without destroying the technological advance. Highly valued shares fall. Companies with weak business models lose access to easy capital. Businesses that attached AI language to ordinary products without producing meaningful revenue are forced to demonstrate results. The strongest companies survive. Some may become stronger because lower valuations, cheaper equipment, and reduced competition allow them to acquire talent and assets from weaker rivals. This is what financial corrections are supposed to do. They separate the technology from the excitement surrounding it. They redirect capital from stories toward evidence. A correction of this kind could be painful for investors who entered near the peak, yet beneficial for the development of the industry. It would reduce the pressure to justify every project with extravagant promises. Managers would become more selective. Investors would demand clearer paths to revenue. Capital would move toward companies capable of converting technical ability into durable cash flow. The technology would continue advancing. The prices attached to it would simply become less forgiving. This distinction is essential because the collapse of an investment narrative does not necessarily mean the collapse of the invention itself. After the dot-com bubble burst, the internet did not disappear. Its expansion accelerated through stronger companies, improved infrastructure, and more realistic business models. The speculative excess was destroyed. But the underlying transformation continued. AI could experience something similar. The third possibility is more serious: an investment air pocket. This would begin not with the disappearance of AI demand, but with a change in its rate of growth. Major corporations could decide that they have built enough capacity for the moment. Some might delay data center projects because of power limitations, construction costs, or uncertain customer demand. Others might discover that businesses are adopting AI tools more slowly than expected, or refusing to pay prices high enough to justify the infrastructure behind them. Capital expenditure would not need to stop. It would only need to grow less rapidly than investors had assumed. That change could move through to move through the supply chain with surprising speed. Cloud providers would revise spending plans. Orders for advanced processors, memory and networking equipment could weaken. Semiconductor suppliers would face lower forecasts. Data center developers might postpone construction. Utilities that had prepared for extraordinary electricity demand could find some projects delayed. Equipment manufacturers, engineering firms, and private lenders connected to the expansion would feel the consequences. The market would then confront a difficult truth. A company can report growing revenue and still disappoint investors when the price of its shares assumed even faster growth. The trigger would not necessarily be bad results. It could be results that are merely less extraordinary. This is the danger of elevated expectations. They change the definition of failure. When little is expected, modest progress can produce enthusiasm. When perfection is expected, excellence can produce a sell-off. An AI investment air pocket might therefore begin with a small reduction in orders, a cautious earnings forecast, or a major customer delaying new capacity. The first decline would appear limited to a particular company or sector. Then, analysts would revise estimates elsewhere. The assumptions connecting the ecosystem would be examined again. If cloud spending slows, what happens to chip demand? If computing becomes cheaper, what happens to margins? If model developers cannot charge enough to cover their costs, who absorbs the difference? If enterprise customers gain productivity but AI suppliers struggle to capture the value, were investors rewarding the wrong layer of the system? The reassessment could be severe even while AI usage continues rising. The fourth possibility is a broader market crisis. This would require more than disappointment in one technological theme. AI weakness might combine with persistent inflation, rising bond yields, tighter credit, geopolitical conflict, or a weakening consumer. A correction that begins in expensive technology shares could then spread into other areas of the economy. Interest rates are particularly important. The value of a company whose greatest profits are expected far in the future is sensitive to the rate used to value those future earnings today. When bond yields rise, investors can obtain higher returns from less speculative assets. The present value of distant corporate profits falls, and highly valued growth companies become more difficult to justify. A market already concentrated in a small number of enormous businesses may be especially vulnerable to this change. Market cap-weighted funds automatically hold more of the companies that have become largest. This structure is not inherently defective. It provides low-cost exposure to a broad index, and has served many investors effectively. But the label broad index can create a false sense of equal distribution. When a few companies account for an unusually large share of the index, investors who believe they own a diversified representation of the economy may actually possess substantial exposure to the same technological narrative. If those leaders decline together, passive ownership does not create the selling, but it transmits the losses widely. Pension funds hold the index, retirement accounts hold the index. Insurance portfolios, university endowments, and ordinary savers hold the index. Concentration transforms the fortunes of several companies into an issue affecting millions of households that may never have chosen those individual shares directly. A broader crisis could also move through credit markets. The largest technology companies possess strong balance sheets, but the companies surrounding them may not. Data center developers, power projects, construction businesses, and secondary suppliers may depend more heavily on borrowed money. If expected demand weakens while interest costs remain high, refinancing becomes more difficult. Assets built for rapid expansion may produce inadequate cash flow. Lenders become cautious. Projects are cancelled. Workers are dismissed. Local governments that anticipated new tax revenue face slower growth. Utilities that invested in grid expansion may encounter political disputes over who should pay for infrastructure that is no longer being used as quickly as expected. The cost of a boom is never limited to the price chart. It reaches employees whose compensation is concentrated in company shares. It reaches workers hired during the expansion. It reaches cities that reorganize development plans around new facilities. It reaches suppliers that expanded production for orders assumed to be permanent. It reaches late investors who entered after seeing years of rising prices and mistook past returns for protection against future losses. None of these scenarios is a forecast. Each describes a pathway. The catalyst could be weaker than expected AI revenue. It could be slower cloud demand, export restrictions on advanced chips, shortages of electricity, higher bond yields, regulation, renewed inflation, or geopolitical conflict. It could be disappointing evidence on productivity. Businesses may discover that AI saves time in some tasks, but creates new costs in verification, security, and integration. Employees may produce more material without producing proportionally more economic value. Companies may adopt AI because competitors are adopting it, not because the financial return has been clearly established. Alternatively, the catalyst may never arrive in the dramatic form bears expect. Earnings may continue rising. AI services may spread. Infrastructure constraints may keep computing capacity scarce. The market may remain expensive because investors believe scarce strategic assets deserve premium valuations. This is why disagreement among large financial institutions matters. Bank of America's cautious analysis identifies valuation, concentration, and internal market weakness as reasons to consider taking profits. JP Morgan has argued that today's leading technology businesses are supported by real profitability, strong cash flow, and measurable demand in a way that distinguishes the present cycle from classic speculative bubbles. Goldman Sachs has remained constructive on the broader market and the scale of the AI build-out, while also recognizing that the return on enormous capital expenditure remains a central uncertainty. Citigroup, UBS, Goldman Sachs and other institutions have published optimistic S&P 500 targets supported by expectations of continued earnings growth and AI investment. These views cannot all be converted into one simple answer. Wall Street is not a single intelligence. It is a collection of competing models. One institution may assume that corporate margins remain high. Another may expect interest rates to decline. One may believe AI will create rapid productivity gains. Another may focus on how much growth is already reflected in prices. Their conclusions depend on assumptions about variables that cannot be known with certainty. That does not make research useless. It makes humility necessary. The purpose of a warning is not always to predict disaster. Sometimes it is to reveal where the system has become dependent on favorable assumptions. The purpose of a bullish forecast is not to guarantee prosperity. It demonstrates how strong the outcome could be if earnings, investment, and productivity continue developing as expected. An intelligent response to these competing views is neither blind optimism nor automatic panic. It is examination. Concentration deserves examination because hidden concentration remains risk even when contained inside a familiar index. Valuation deserves examination because the quality of a company and the price of its shares are not the same thing. A magnificent business can be a poor investment when purchased at a price that assumes decades of nearly flawless execution. A mediocre business can occasionally become a profitable investment when expectations are sufficiently low. Price determines what success must occur before the investor receives an acceptable return. Quality alone does not answer that question. Diversification also requires more thought than the ownership of many ticker symbols. A portfolio can contain hundreds of companies and still depend heavily on the same economic force. Several businesses may appear different while relying on the same cloud spending, semiconductor demand, interest rate environment, or investor appetite. True diversification concerns sources of risk, not merely the number of holdings. These are broad principles, not instructions to buy or sell any security. The financial circumstances, time horizons, and objectives of individuals differ too greatly for a historical essay to provide personal investment advice. But history does permit one general observation. Periods of great innovation create both extraordinary companies and extraordinary mistakes. The difficulty is that they often look similar in the beginning. Both speak about the future. Both attract ambitious people. Both receive capital. Both produce convincing demonstrations. Only time reveals which businesses created durable economic value and which merely occupied a fashionable position while money was abundant. A Churchillian mind would probably neither flee from artificial intelligence nor kneel before it. It would prepare. It would seek access to the technology, protect the infrastructure behind it, and understand its implications for industry, intelligence, defense, and national power. But it would also demand evidence. Are the systems producing measurable results? Are resources being allocated to strategic objectives or spent to avoid the embarrassment of appearing cautious? Is the country building independent capability or merely increasing dependence on a handful of corporations and fragile supply chains? Are investors evaluating risk or accepting concentration because it has recently been rewarded? Such a mind would understand that progress requires courage. But courage is not the worship of momentum. Courage does not assume that rising prices are evidence that danger has disappeared. It recognizes that the moment of greatest public confidence may also be the moment when preparation is most neglected. The deeper risk may not lie in artificial intelligence itself. It may lie in a financial culture willing to place extraordinary faith in a small group of companies, a single technological narrative, and profits that still belong partly to an uncertain future. The AI revolution may be genuine, the infrastructure may be necessary, the companies may remain powerful, and the market may still be dangerously priced. All four statements can be true at the same time. This is what the language of bubbles often fails to capture. A bubble does not require the underlying invention to be fraudulent. It requires only a gap between what an asset can plausibly deliver and what investors have already paid for it. That gap may close through falling prices. It may close through rising earnings. It may remain open for years. But it cannot be ignored merely because the technology inspires awe. Civilizations advance because they dare to build the future. They endure because they refuse to purchase that future at any price. The discipline required now is not the discipline of retreat. It is the discipline of distinction. To distinguish invention from investment, growth from valuation, confidence from complacency. strategic necessity from fashionable excess, and courage from the reckless belief that success has repealed risk. The machine may become more intelligent, the market may climb higher, but neither intelligence nor rising prices can repeal the oldest law of finance. When expectation outruns reality, reality eventually collects the debt.